Okay, for those of you who don't know Arca, that's our strapline, helping clients to protect capital values and enhance returns throughout the property cycle. We're essentially pioneers of short-term property market risk management, regulated by both the FCA and RICS. And we've got between us over 20 years of experience dealing with financial products linked to the performance of real estate. And we've transacted over 3 billion. So what do I mean by short-term property market risk management? Well, fund managers, property practitioners, their job is to essentially build portfolios of individual assets. And if you like, once they've built that portfolio, it moves like an oil tanker. So the characteristics of that portfolio are, when you buy an asset, you're locked in for a period of 5 to 7 years. You're taking on the asset-specific risk of that. You've got long time delays in terms of buying and selling. It's expensive to trade. It's gone up by 1% this year, courtesy of George Osborne. And you've got to manage all the various associated risks around that. By short-term property market risk management, we're talking about the short term. So you've now got a tool in your toolbox to use at the front end of the curve. You can buy or sell exposure to the UK real estate market. It's quick and easy to execute. It's cheap to execute. And the big fund managers that are already active, they don't see this as a competitive tool. They see it as a complementary tool, something that's different that can help them with various constraints that they're faced with. And they're using it as a portfolio overlay for their existing portfolios. So just to sort of accentuate the point a bit, as I said, fund management, property risk management is all about managing the risks associated with an individual property at the asset-specific level. If you like, it's the bottom-up approach. And what we're trying to focus on is the top-down approach, i.e. from the portfolio level down or from the market down. And as you can see, there are various different factors of note. At the asset-specific level, it's key to get asset selection right, and it's key to have good risk management or asset management going on through the life cycle of the asset, from the purchase point to when you sell it. But at the top-down market approach, you're obviously making tactical asset allocation decisions, strategic asset allocation decisions, and sometimes those are divorced from the property team. In fact, those decisions could be made at a higher level, and then you get the sort of go-ahead to either buy or sell, and the property team then has to execute those strategies. But having a tool that you can use to trade market risk is obviously very effectual through the cycle. Moving on, let's look at the cycles since the end of the Second World War. We're going to use data courtesy of Paul Scott prior to IPD, now MSCI. So he collated data between 1947 and 1970. IPD started in about 1981, but they then went back to 1971. So we've got a comprehensive data set here. It's slightly cut off at the end, but I think you can see the three key cycles during that time period. And this is a UK all property index. So what we see here is essentially, since the Second World War, a period of 3 elongated cycles. And you can see the upwards part of the cycle is generally a lot longer than the downturn. And that can last for a period of 8 to 12 years. And generally, you see a consistent cycle of upwards capital values incrementally over the cycle. And there's a lot of serial correlation in returns of property. So as far as cycles go, it's much more easy to read than equities or bonds, which could be more reactive to short-term events or market movements. But on the downside, you can see that the drop, if you like, is very accentuated and usually very short term, so a couple of years in duration. The other thing to note when you look at this data, if you strip out the income, is you can see the capital values essentially correlate very closely to the total return. And that's no surprise, therefore, but the difference is the income portion, which, as you can see there, is very flat and stable. So really, when you're trading real estate, the income portion is static, it's stable. You've got to manage the capital values or the market risk. And property futures give you that capability. So just drilling down a bit further into this data, you can see with income returns, over that time period, you've got a minimum income in any 1 year of 3.9%, a maximum of 9.8%. Those, of course, are outliers. Your mean average over that time period is 6.6%. But the important thing to note is the risk profile. You've got an annualized standard deviation of about 1%. So if the average is 6.6, you can say next year I'm either going to have income returns at 5.6 or 7.6 or somewhere in between, and I've got a very high degree of probability that that will be the case. And that, of course, is because the IPD index is a diversified portfolio of index. If one building suddenly loses a tenant, it's not going to be reflected in the index. There are thousands of buildings in there. One tenant going bust is not going to make a difference. Also, it's institutional grade, so the likelihood is a lot of these leases are going to be upwards only and long term. So even during the downturn of the great financial crisis, income portion was relatively secure because it didn't change the lease structure of those leases that were already in motion. By comparison, if we look at the capital returns on the same basis, you've got a minimum capital returns during that time period in 1 year, minus 26.3%, and a maximum of 23.6%. So you can see there's a massive swing between the minimum and maximum. If you break that down over that time period for the mean, it's a 4.4% return. However, you've nearly got a 10% standard deviation of returns. So what that's saying is next year it's either going to be 14.4% potentially, or it could be -6%. So that's the risk you've got to manage when you're looking at real estate and you're trying to maximize your returns through the cycle. You can spend 12 years building a great portfolio, and you can see the capital values be wiped out over a period of 2 years, and you're back to zero or worse. So just obviously this is hand drawn, not quite as good looking as Marty's, but I've just tried to show the sort of same cycle that Marty demonstrated, but just that sort of 12-year upwards part of the cycle. You can see it's a much longer gradual incremental gains, and then the downward cycle is a much shorter time period, but very much more accentuated. And the key point here is you've obviously got your peak, you've got your trough. You know, none of us know where these are. There's no point trying to predict that. But what you can do is, through the cycle, put more risk on, and you do by buying assets. That's what fund managers do. But when you get to the top end of the cycle, you might, by traditional metrics, by the mean average over time period, you might see that the fundamentals aren't stacking up. Now that could mean when we go 20% above the long run average, when you account for inflation as well. So in real terms, you're in bubble territory. However, that period of bubble territory could last for a period of 5 years before as has happened during all those 3 cycles, a fall of 40% during that 2-year downturn. So the key here is, with IPD futures, you can manage your portfolio, your market risk through the cycle by putting more risk on the upwards side. And then when you get toppy, like an insurance policy, you can start to take risk off. You can keep your assets, you don't have to sell your assets, you're just effectively insuring your portfolio against that fall, that sharp, sudden fall. I'm just going to talk about 2 case studies using IPD futures, and we're going to talk about how you can trade them during the build-up to Brexit, and indeed once the result comes through. So the first case study is a sector switch, and this is a very good trade because it's essentially market risk neutral. You're effectively long one segment and short the other. So regardless of the outcome of the referendum, whether the market shoots up or shoots down, from a risk-adjusted returns point of view, you're going to be well placed because you'll benefit if it shoots up with one leg, and if it shoots down, you'll capture the returns, or your portfolio will be protected. The second case study is an event-driven trade. Rather like the election last year, we saw little activity in the market in the UK until after the election, until after the political risk of a Labour government and the tax implications of that was taken off the table. And we'll show how a nimble hedge fund traded the day after the election and was the first entrant back into the UK property market using the futures. Okay, so this sector switch is a real-life case study by a client. It was driven by a sort of reweighting desire. They wanted to get more exposure to the industrial sector and sell shopping centres. Now, they did it in September of last year. Essentially, they bought industrials at 15.5% in 25 million, which was where the market was at that time. And they sold shopping centres at 9.5% in 25 million as well. And the margin difference between those 2 segments was 6%. And they were going to make or lose whatever the margin difference was when the indices settled 3-4 months later. So it's very short term, but this is demonstrating how you can use the futures contracts for short-term trading. So this side shows you their entry points, if you like, and this is September when they traded, and this line here is the shopping centre index, and this line here is the industrial index, and you can see where they settled. The difference was just over 6%, actually 6.8%. So the cash flow returns meant that they gained on the industrial leg, because that went up from 15.5 where they traded and settled at 16.8. So they had a positive cash flow of 320,000. Conversely, on the shopping centres, they had a negative cash flow of minus 136,000, but a net position meant they were 183,000 in the money, which gave them an annualized return of 1.3%. And during that sort of 4-month period to the end of the year, meant they outperformed cash, and they were hedged, and they'd basically gone overweight, or got out of their overweight position in shopping centres, and they bought more exposure to industrials. So strategically, it ticked their aims as well, regardless of the outcome. Okay, case study 2, post-general election last year. As I said, day after the election, client called us up and said, right, political risk off the table. I want to buy the rest of this year's returns. I want to buy calendar 2016, and I want to sell calendars 2017, 2018, and 2019 in 60 million. This guy was the first guy back into the UK real estate market. That trade was executed a week later. Anyone trying to implement their strategic decision to go long UK real estate after the election are probably still signing completion papers now, or could be. So it demonstrates the speed to execute. Obviously, the costs are very much less, only less than 0.5%. One could argue this product's become 1% cheaper because there's no stamp duty on it as well in the last 3 months. So the benefits to trading are obviously very real on the cost side. And as you can see, this was where he traded his 2015. So he traded at 10.15. It actually settled at 13.25%. He bought this year's returns in May last year at 6.5%, and that's currently roughly where the index or the price is to trade that contract. And he's short 2017, 2018, and 2019 at 5.75%. So that's roughly where income comes in. So he's roughly capital neutral, but if there is a sell-off and a collapse over this time period, he's well protected for his portfolio and the capital values. Now, there's nothing to stop him if suddenly during the outcome of Brexit is we remain and we suddenly see a spike in UK real estate towards the end of the year, and he thinks that that's going to carry on into 2017. All he has to do is close out this leg or this calendar year, and then he keeps his short positions for the following 2 if he thinks that's where the market's going to come off. So it's a very flexible tool. You can buy or sell exposure in discrete calendar years, and it's just another tool in the toolbox for fund managers to use as and when required. Just going to leave you with some of the benefits, which we've generally covered, but hopefully you can see where it fits in your toolbox. Thank you.